With geopolitical conflicts on the rise, the Fed may reconsider its stance on raising interest rates this year, which means that cash is going to continue to be yielding near 0%. If you have additional cash sitting on the sidelines and are unsure of what to do with it, this video will help provide you with some options to consider. Let's get into it. Hello and welcome to another video from One Up Financial. I am your host, Eric Persogna, CPA and Certified Financial Planner, here to help you increase income, reduce taxes, and invest smarter in retirement. Before I dive into this video, I just want to take a moment to think about and pray for the innocent people in Ukraine that are being forced to flee their country, and even the innocent people in Russia who don't want anything to do with this war and they just want it to be over, and their country is literally being decimated with sanctions and everything else. So just wanted to take a moment and really acknowledge that and think and pray for those innocent people out there. So moving on to the video, I really want to address a popular question that I get a lot from not only clients but prospects, and that is, what do I do with my excess cash that I have sitting in a bank account paying 0.00001%? But before I answer that question, I think it's important to address a few different things. So number one is what I call an emergency fund. And basically all it is a savings account reserved for unexpected costs. Now, the CFP board, the Certified Financial Planning Standards Board, recommends that individuals have at least 6 months worth of living expenses sitting in some kind of liquid cash-like vehicle. So for example, if you're spending $5,000 a month on rent or your mortgage and other living expenses, that equates to about $30,000 that you want to make sure you have liquid and reserved for emergency purposes. So I say that because that's kind of the first thing I want to make sure that everyone has checked off on their box before they look to invest some of their excess cash. Next thing, so number two, what I also like to look for is any outstanding debt, specifically high interest debt. So that's something like credit cards or even a personal loan. So if you think about it, if you have, let's say, a loan that has a 10% APR and you decide to pay it off early with some of your excess cash, you're in a sense getting or receiving a 10% return on your money guaranteed. So I always like to look at that as well as the emergency fund before starting to think about, what should we do with this cash? And lastly, I think this is really important too, is thinking about what the intention is of this cash. So when someone says, hey, what do? I have $50,000 or $100,000 sitting in cash. What do I do? My next question is, well, what are you trying to do with it? Are you trying to save for a down payment on a house, like a vacation home? Do you want to retire in 3 or 4 years? Like, what is this money supposed to do, or what do you want this money to do for you? I think some people just want it to perform better than the rate of inflation, which I completely get, given inflation is nearly at all-time highs. So I think that's important too, in addition to the emergency fund and looking at your high interest debt, is figuring out what you want this money to do for you. Because once you understand that, and once you get really clear on that, then I think you'll be able to more easily strategize and figure out what type of investment strategy is best suited for that goal, which will help stop future problems or help alleviate future problems that may arise down the line. So once you've established a good emergency fund, and once you've kind of cleared out all of your high interest debt, and you have kind of that goal set in mind, or you have an intention of what you want to do with this cash, here are some options that you can consider for investing some of your cash. And I kind of broke them down between 3 different areas. So one, short-term goals. So that's anything like 1 year or less. Mid-term goals, so I kind of loosely define that as anywhere between 3 to 5 years, maybe a little bit longer. And then long-term goals, so that's like 7 to 10 years or even longer out. Before I get into any of this discussion, I just want to say that this is not investment advice, that everything I talk about here in this video is for informational purposes only and should not be construed as tax or financial advice. So please consult your CPA or your financial professional before making any investment decisions.
So what's on your mind, Kimasabi? Why am I listening to you?
Okay, so let's get into it. Short-term goals, so anything 1 year or less. The first thing that I would consider here in this area with your cash is quite simply just a money market account. Now, when I say money market account, I don't mean going to like a large bank, like a big financial institution and opening up a money market account there, because the interest rates are going to be incredibly low. I would prefer looking at institutions online, and they're called neobanks. And because these banks don't have retail offices, retail branches, they can save a substantial amount of money and in turn give that money back to depositors in the form of interest on their money market accounts. So for example, if you do a quick Google search, top money market rates currently 2022, NerdWallet, there's a bunch of different resources out there, but some of the banks on that list are probably paying, like last time I checked, anywhere between 0.5 and 0.7% depending on where interest rates are, which again is not great, but it's a lot better than what you're getting in a money market account sitting at one of these larger banks. Now, I will say a couple things that you want to consider before opening up these accounts is really understanding the structure of a money market account, because with money markets, they only allow you a certain limit of transactions per month. So if you go over that, then you can start getting fees. In addition to that, you always want to make sure too that the bank that you're entrusting your money with is FDIC insured, right? So if for whatever reason the bank goes under, then you know that your money is safe and insured up to a certain dollar amount. Next option for your short-term goals could be what's called a Series I bond. Now, these are government bonds. They are long-term, but you can still utilize them for your short-term goals. So basically, they are bonds issued by the US government, and you're only allowed to invest up to $10,000 per person per year. So that's one of the drawbacks to the Series I bonds, but one of the big benefits is the current interest rate that you're receiving on these bonds. The interest rate is tied to inflation, and with inflation at the current levels, the rate on the Series I bonds right now is north of 7%. Now, I said you can utilize them for short-term goals, even though they're long-term bonds. So this is kind of how that would work, is you would, let's say, for example, buy a Series I bond on treasury.gov, and you would potentially sell it, let's say, 13 or 14 months later. Now, if you do that, because it's a long-term bond and you're selling it in the short term, you actually forego a few months worth of interest. I believe it's 3 months worth of interest that you would forego. But if you just do the math on that, 1 year at, let's say, 75% of a total of 7% rate of return or 7% coupon gives you more than a 5% interest on that short-term money. So that's substantially higher than even the highest paying money market accounts. Now, again, you can only put in $10,000 per person. You can actually put in a little bit more if you utilize your tax refund for the Series I bonds. In addition, I should note too that the Series I bonds, the rate is reset semi-annually. So you kind of want to pay attention to inflation. So if for some reason inflation just completely drops, then the interest rate on the Series I bonds might not be as attractive. But at least at the moment, it presents a really interesting option for short-term cash, or at least a portion of short-term cash, up to, let's say, $20,000 per married couple per year.
What else you got besides connections to the airport?
Lastly, in this short-term bucket, this isn't necessarily a place where you could invest cash, but it's more so kind of like a personal finance hack, where if you utilize your credit cards wisely, you can actually earn twice the rate of what even the highest money market rates are currently paying. So for example, utilizing your credit cards for either bonus rewards or introductory bonuses, or just cashback rewards on your monthly spend. So for example, the credit card that I currently use, I get 1.5% cash back on everything that I spend. So if you just do some simple math, and let's say you spend $5,000 or $6,000 a month on just your day-to-day living expenses, and let's call it $3,000 of that can be utilized with your credit card. So like going out to eat, your groceries, your utilities. $3,000 a month per year ends up being $36,000 at a 1.5% interest rate. So I think when we look at options for investing cash, we don't necessarily think about all the other things out there that we could be earning money on, and just looking at your spend and being able to utilize a credit card wisely, that is making sure you pay it off every month so you don't have to incur any interest, but using that credit card wisely so that you can actually earn cash back on your day-to-day spend.
Looks as good as on paper. We're in the kill zone, pal.
So next, going into the midterm goals, right? So this is anywhere 3 to 5 years, a little bit longer than that. I think that both the money market and the Series I bonds could also play a role in your midterm goals as well for your cash. Now, money market accounts, again, are not going to give you a huge return on your money, and that's more so for someone that's really risk averse. They don't want to put a lot of their money up into either the stock market or the bond market. They want to just keep things steady and safe, which is totally fine. And a money market is a perfectly fine place to invest. But it's not going to even keep up with the rate of inflation, and your rate of return is probably going to be 1% or even less. But it's still an option. As are, I should say, the Series I bonds. So you don't necessarily have to sell them after 1 year. You can decide to hold on to them for 3 or 4 or 5 years. And if you hold on to the Series I bonds for, I believe it's 5 years, then you don't incur any interest penalties, or you don't forego any interest payments by holding on to it for at least 5 years. So you get the full coupon, you get the full rate of return on those bonds if you hold it for at least 5 years. And again, if inflation stays high, maybe not as high as it is now, but it still stays relatively elevated, then the rate on those bonds could still be substantially high relative to other interest rates in the marketplace. Lastly, for your midterm goals, I think just a standard brokerage account or investment account is a good option. Now, how you invest in this brokerage account is really going to be dependent upon you and your risk tolerance, as well as your time horizon. So for me, if I had a goal of, let's say, putting a down payment on a vacation home in 5 years, and I would open up a brokerage account, I probably wouldn't be too overly aggressive with my investment strategy in this brokerage account. I would probably have a higher weighting in a diversified portfolio of fixed income, so that short, medium, and long-term government and corporate bonds. And then I'd probably have a smaller portion in stocks, specifically ones that are paying dividends and that have exhibited a dividend growth pattern for a considerable amount of time. So I would probably be invested in the market, in the stock and the bond market, but my strategy would be a little bit more conservative, just given that my midterm goal is, anywhere from, let's say, 3 to 5 years. And as I get closer to that goal, as I get closer to that 3 or 4 or 5 year time frame, then I'm going to slowly start to make my investment strategy more conservative and peel off cash from my brokerage account into my money market account, because when that 5 year time frame hits, I want to make sure that I have my cash secure and liquid and available for that down payment.
Okay. When the market opens tomorrow, I want you to buy 1,500 July 50 calls. You hear me?
Lastly are the long-term goals. This is like 7 or 10 years, even longer out. Now, because they're long-term goals, we have a little bit more options in this category. So first option is, again, I think a brokerage account works really well here. The only difference is you could probably be a little more aggressive with your investment strategy because you have a longer time horizon. So again, just speaking for me, I would probably have at least 70 to 80% of this strategy in stocks, and probably more weighted in growth and momentum, and less on value and dividends. So the brokerage account, again, I think really works in a lot of different areas, more so mid and your long-term goals. It just depends on how you want to invest within that brokerage account. Next are what I like to call the low-hanging fruits. And you probably have all heard of these, but looking at your IRAs, your Roth IRAs, and your 401k plans where your employer provides a match. So if you're not currently contributing to a Roth or traditional IRA or even your company 401k plan to get the company match, then those are some things that I would definitely consider looking at. So depending on your age, you can invest up to $6,000, at least this is for 2022, $6,000 in an IRA, an additional $1,000 if you're over the age of 50, and 401k limits are a little different than that, which I'll kind of get into. But I call those the low-hanging fruits because they're pretty much an easy way for you to save your own money and get a tax benefit for it, whether that's now through a traditional IRA or whether that's in the future through a Roth IRA. So if you're not utilizing some of those basic savings vehicles like IRAs and 401ks, that's definitely something that I would make sure that I check off on the box. Now, in addition to the IRAs and the 401ks, for those that are contributing to a 401k plan, I would look to see if your plan allows for an in-plan Roth conversion and after-tax contributions. And the reason I say that is because if your plan allows for those things, then that means you're able to contribute a lot more than what even the max is that most people can contribute to a 401k, which in 2022 is $20,500. So if your plan allows for those things, the after-tax contributions and the in-plan Roth conversion, then you can actually put in $40,500 on top of the $20,500 that you're currently putting in. Now that $40,500 might be less if your employer is matching. And again, I could do a whole video on this strategy, but I'll just kind of keep it top level for this purpose here. But utilizing this strategy will allow you to put in a substantial amount of money into your 401k plan through what's called a MegaBackdoor Roth strategy. So again, if you have some cash sitting on the sidelines, your 401k plan allows for this and you're still contributing to it and you're maxing it out, then I would look at this strategy because it is a great way to save a lot of money into an after-tax account like a Roth 401k. Now, the next two options I think are more so for those individuals who have a substantial amount already in an investment account like a brokerage or an IRA. They have stocks, they have bonds, but they want something different. They want like an alternative kind of investment. So I'm going to give you two platforms that I've seen gain a lot of traction over the past few years. And one of those is a platform called Fundrise. And Fundrise is a way for investors to put money and pool their money together with other investors, which is called crowdfunding, and invest in large real estate deals. And these real estate deals will generate not only return on your investment, but also passive income. So it's a nice way for investors to gain exposure to the real estate market without having to go buy a brick and mortar piece of real estate or a rental property. They can own, let's say, a portion of a large real estate deal with a bunch of other investors and start to receive passive income, passive cash flow from that investment. Now, there are risks associated with this, like any investment, and it is real estate, so it is something that you need to be comfortable with and really understand exactly the nature of how this investment works. But it is a really unique and interesting alternative investment option for those looking to generate passive income and to have some exposure to the real estate market. Another alternative that I've seen gain a lot of popularity in recent years is a platform called Masterworks. And Masterworks is basically just a way for investors to put their money into the art market. Now, it's not necessarily like an index like the S&P 500, but the art market in general, if you look back to 1995 all the way through 2021, the art market has outperformed the S&P 500 by, I think, over 160%, something ridiculous like that. In addition, the art market doesn't necessarily correlate really well with the broader market, which is good because that means that just because the market's going up or down doesn't necessarily mean that the art market is going to move lockstep with, let's say, the S&P 500 or even the Dow. So now you're not investing in like an index art market per se, but you're actually investing in pieces of artwork from famous artists like a Monet or a Warhol. and you're investing in their artwork, and you own a small fraction of whatever that piece of art is, and you get to share ownership in the appreciation of that art over time. So again, it's not something for everyone, but it is an interesting alternative investment that I think people might want to consider with some of their excess cash. Last but certainly not least is starting a business. So whether that's a side hustle, so if you're in retirement and you have a hobby, turning that hobby into a business that generates profit, or whether that's just a problem that you found in the marketplace and you created a unique solution to and you want to start profiting from it, and you start a business. Now, starting a business obviously is very risky, right? It's a lot more risky than, let's say, investing in a 60-40 portfolio of stocks and bonds. But I think it is suitable for some people out there that just have more of an entrepreneurial spirit in them. Starting your own business can actually be highly rewarding, both financially and emotionally, if you're very successful with it, although it is much higher on the risk spectrum, so that is something that you should consider as well.
Do you realize how much money he just saved us?
If you have any questions about what I discussed today and would like to chat further, please call or email me. I'm happy to talk to you personally. Thanks as always for watching our videos. If you're interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks for watching, and we'll see you in the next one.